My guess is that those of you who are watching this video today belong to one of two groups of traders or market participants. The first group among you are naysayers in the idea of charting. You think charting is some form of voodoo. The second group among you see that there is benefit, there's value in charts. Chart help provide you some sort of edge in your trading. To the naysayers among you, there is very little that I can say. It's not going to be my attempt to persuade you that you're wrong. But what I'd like to do is just give you some sort of idea of what I see as the benefit of price charts to help give you a little bit better understanding of my thinking. You know, you've heard that most price charts fail, that you're a believer that price charts do not accurately forecast price. And I have made my living from charting for more than 40 years, and I will tell you, you're absolutely right. Price charts do fail. They fail much more often than they're correct. And price charts, in my opinion, do not provide a great tool for price forecasting. But here is what I see as the benefit of charts, and it'll give you a little bit better feel for how I view this whole world of classical charting principles. The first thing charts show me is where a market has been, where a market is now, and perhaps the path of least resistance for a particular stock or Forex pair or futures contract. And that information in and of itself is very, very valuable. The second thing that charts show me, if they set up just perfectly, is that there may be some accumulation or distribution of shares or contracts by very strong-handed people at a certain price level, that we see signs of accumulation or distribution. That in itself is very valuable to me. Then the third thing, which for me is really the real value of charts, is it can indicate for me the opportunity for very, very highly skewed asymmetrical reward to risk trade, a point in the history of price where I can place a bigger bet than normal with a limited risk. And that to me is where the edge of charting comes from. I would now want to address some comments to those of you who would consider yourself chartists, or who believe that charting has some benefit to the way that you trade, the way that you deal with the markets. Keep in mind, I'm a classical chartist. My training and my frame of reference is the book written by Richard W. Schaubacher so many years ago. It's not my intent here to persuade other chartists that my way of charting is right. I have the feeling that if it works for you, that's great. Whatever works for a trader, that's where a trader needs to go. But I'd like to talk a little bit about how I view charting when I'm thinking about my own charting. What are some of the things that would define that? And so let me run through some of those things. Charting is an interesting thing. If you get in a room, 10 different chartists, and show them a chart, you're going to get about 15 different opinions. And so charting is just not always one particular way of looking at a market. There can be a variety of ways. But give you some highlights of my approach to charting dating back to 1981. I trade primarily futures and Forex markets with a little bit equities. I'd say 50% of the trades I do are in the global futures markets, and I trade futures markets in all continents. 40% are in the spot Forex markets, primarily the big currencies, the Australian dollar, British pound, and so forth. I don't get into the exotic currencies, Brazil or South Africa. And about 10% of my trading is based in equities, and that's global equities. But again, my primary emphasis is classical charting principles. I look at weekly charts. That's the basis of my opinion, is the weekly charts. And I use daily charts for timing, and I try to keep things simple. I try to keep as few lines on a price chart as I possibly can. I know that on Twitter people frequently comment on the fact that I use a white background. My goodness, nobody uses white backgrounds anymore, but my charts, I have a white background. I draw very few lines because I think simplicity is the way to go. My approach to charting classically is based on the book written in 1933 by Richard W. Schabacker. I would consider myself to be a Schabacker disciple. There are some secondary things that I look at from a technical standpoint. I pay attention to the CFTC commitment of traders reports, which show the profile of positioning by small speculators, large speculators, and commercial interests. To me, I don't pay week-to-week attention to that data, but I do pay attention to that data if it's near record historical all-time levels. Then that is a factor that I take into account. I do look at a simple moving average, normally just a 14-day moving average. I don't get into whether the moving average needs to be adjusted. It's a simple moving average. I look at the ADX indicator. That is just about the only indicator that I pay attention to. And I also pay attention to what I consider to be analog years. That is an important way to look at markets. The markets tend to behave in similar manners over time. And if you can find a market that is starting to act like some market from 10 or 20 years ago, you study that market from 10 to 20 years ago and try to anticipate what might come next. There are a number of techniques that basically I pay no attention to, and it's not my intent here to create controversy or say that some of these techniques are not useful, because again, if they work for you, I think that's wonderful. These are just indicators that I just do not believe in, quite frankly, and it would include Elliott wave theory. I pay no attention to. I don't pay attention to cycles. I do not like indicators, quite frankly, except for ADX. As far as I'm concerned, an indicator is really a derivative of price. And so why should I study a derivative price if I can study price itself? I don't believe in Gann. I don't look at Fibonacci retracements. I don't pay attention to seasonals. And I particularly almost detest what I call Star Wars charting. And every once in a while, I'll see a chart on Twitter that's got so many lines I get dizzy. It looks like somebody wants to travel into some other galaxy far, far away. And so I refer to them as Star Wars charts. And so that gives you a frame of reference to at least some of the profiles that I use to try to think of myself as a chart speculator. With some of these things as background, now I'd like to kind of do what I'm going to call wading into deep waters and have some comments about charting that a number of you chartists probably will find quite objectionable and disagree with me. But this is my video, so I'm going to present my views on this. But these are beliefs that I have on the concept of charting that I think it creates some problems for chartists, things that I see about charting that I don't happen to agree with. I do not believe that charting has a value for comprehensive market analysis. And I read what some other chartists are doing from time to time, and what I see is they attempt to use charts to come to a comprehensive understanding of a market. And I quite frankly think that most markets, most of the time, defy understanding from a classical charting point of view. And so I do not see charting as being of value for having a comprehensive understanding of what the markets are doing. You know, I hear people refer to the fact that they are going to, let's say, go home and study their charts. And I kind of think to myself, study your charts. The idea that you're studying your charts would indicate that charts, if you just look at them closely, will reveal all things about all markets. And I just don't see that as the reality of using charts for the purpose of market speculation. To me, I'll look at a chart for 2 seconds, and if I don't see something in 2 seconds of looking at a chart, I move on because I don't, quite frankly, believe that the chart's attempting to tell me anything. Another thing about charting is that I really see valid chart patterns, significant valid chart patterns that provide a speculative opportunity as the exception, not the rule. I go by the frame of reference that maybe in a given chart, let it be the S&Ps or soybeans or the price of London cocoa, if I can get 2 valid chart patterns in those markets in a year, that may be about what I'm looking for. And so for me to go in and say I need to have a constant, although ever-changing opinion of the S&P market based on the charts, I think, to me, that's lunacy, quite frankly. There's one thing about charting that I find particularly interesting, and that is something that I would refer to as attempting to create a global macro narrative based on a chart. I see comments quite frequently in the social media where somebody might say, well, I think the price of gold based on this chart is going to do this, and other people pipe in and say, well, that means that the price of oil will do this, and the dollar will do that, and the stock markets will do this. Is what they're trying to do is they'll look at a single chart and attempt to create some sort of global macro narrative based on a single chart. Well, what if you read the chart wrong? Then your whole global macro narrative is wrong. And so it's something that I attempt to prevent myself from doing. Another thing is that I have found charting can be accurate for one period of time and then become quite inaccurate other period of time. There is my general rule of thumb is maybe 4 months out of the year chart patterns will be reliable. The other 8 months out of the year chart patterns will be relatively unreliable. And so I expect this cyclic reliability of chart patterns to take place. Another factor of charting, especially for newcoming chartists, for newbies to the business of charting, they'll take a chart and they'll try to identify every pattern on the chart. And in the process, they misdiagnose charts. I go by the principles of Richard W. Schabacher. To me, those are cardinal rules about charting. And many of the patterns that I've noticed on Twitter or various chart forums, they're drawing in patterns that, quite frankly, just don't meet the rules of those chart patterns, whether it be a head and shoulders or how a trend line is drawn or how a wedge is drawn. I see how they're drawn and I look at it, and they just do not meet the conditions that Richard W. Schabacher laid out for those patterns. Another danger that I see among chartists is they become dogmatic. Again, I come back to a saying that I use quite frequently, and that's strong opinions weakly held. I may have a strong opinion on a market, but if I have a position in that market that is not consistent with that in terms of profit or loss with the opinion of the market, I need to change my opinion in the market. I get criticized quite frequently on Twitter and stock twits for having a negative opinion on one market one week and a positive opinion on the other market on a market the next week. Well, I think traders need to be flexible. They can't be dogmatic. Dogmatic opinions normally lead to large losses because people become convinced they're right. They dig in their heels and they become dogmatic on what they believe a market's going to do. There's one aspect of charting, classical charting anyway, that I would warn people against. In the first place, I am not a believer in day trading. I think the odds against someone being successful in day trading are quite small. As a matter of fact, I saw an article this last week, which included a number of research projects that have been done, either scholarly research projects or reports from various exchanges around the world, that said that only 1% of day traders are consistently, regularly profitable in the markets. Day trading is a losing proposition. I'm sure there are day traders among you who are quite profitable, and that is the case. I know some excellent day traders, but far too many people get into the markets thinking they're going to be day traders. And classical chart breakouts in particular are not a very reliable way to become a day trader. I do trade classical chart breakouts, but I do on weekly charts and on daily charts. Daily charts, classical charting is not an effective way to trade the markets, because even on daily charts, there are more false breakouts, it seems, these days than there used to be. I'd go back into the late 1970s and the 1980s when a market would break out from a chart pattern, and it was pretty reliable. You could almost bet that the chart pattern would fulfill the implications that it had, where today I am seeing far more false breakouts, premature breakouts, erratic breakouts than we did in the past. I've had to adjust the way I trade based on that. I pay less attention to the spindles on candlesticks because I think that they're driven by high-frequency traders running stops. I pay much more attention to weekly charts, and I especially pay attention to closing price charts. You know, closing prices are the most single important price of the day in anything that is traded. The Friday close is the single most important price of the week for anything that is trading. So I want to be paying attention to that. There's another point that I'd like to make about charting, and that is deals with a subject which I call morphology, that charts morph, that what we may see as a particular pattern one day will break out and fail and then morph into an entirely different pattern. And I think that's especially true because I look at chart patterns that are somewhere between 10 and 26 up to 1 year long. That's kind of my sweet spot, is a chart pattern that's about 20 to 26 weeks long. And if I really study a chart pattern that's 26 weeks long, what I find is that that chart pattern becomes the tradable chart pattern for me, is made up of a whole number of smaller, shorter duration chart patterns that failed immediately or failed to meet the expectations that that smaller chart pattern would have. And so charts tend to morph over time. You cannot take a fixed view of Head and Shoulders and say, this Head and Shoulders has to work, because the Head and Shoulders can become just the left shoulder of a larger Head and Shoulders, become part of a rectangle pattern. And so there's a tendency of charts to morph over a period of time. Now, sooner or later, a chart will form a chart pattern which actually works and is tradable. And I think that's one of the challenges of chartists, is to have the patience to wait for charts to get through the morphing process, and then the discipline to pull the trigger, realizing that I recognize, I mentioned that my win rate over time is just over 40%. That means 60% of my trades are going to be failures, and they may be failures because the chart pattern that I'm playing and that I'm trading morphs into something else, and it becomes a losing trade, or it may mean that it had a false start and then went. And so we have to understand that charts are not fixed things over time. They tend to morph. And but the interesting thing is, I hear people say, well, I can't trust charts because they break out and then fail. And sophisticated chartists understand that charts that fail oftentimes tell a bigger story. That I look at a chart pattern that fails, and that to me may give me the insight that I need to place a bet on the chart. The fact that it failed may be a story into itself. And then the final point that I want to make about chart pattern and kind of this hot issue listing that I have, which I'm going to go into some detail, and that is that I pay very little attention to chart patterns that I place into the category of diagonal. And I look at a chart pattern and I define it as either a horizontal pattern or a diagonal pattern. A diagonal pattern would be a symmetrical triangle. It would be a pattern through which the breakout take place on a boundary line that's slanted. And so it could be a rising wedge, falling wedge, symmetrical triangle, or a trend line. I do not believe that diagonal chart construction is reliable for a trader. And I'm going to go a little bit more into that because most of the charts that I see in the social media have diagonal chart construction drawn on them, which I believe is a trap for chartists. Let me explain. I place all of chart patterns into one of two categories. I define a chart pattern as a diagonal pattern or a horizontal pattern. A diagonal chart construction is one in which obviously the boundary lines are drawn on a slanted basis on a chart. A horizontal chart pattern is one in which at least the important boundary lines are flat or horizontal across the chart. As a trader, I want to trade horizontal chart patterns. The reason is that diagonal patterns, even though they may end up being a valid pattern, are far more likely to morph. They're far more likely to provide tricky trading situations. Let me go through some examples of diagonal patterns so that you can see exactly what I'm talking about. Here is a chart of the Dow Jones Transport Index. A trend line by nature is a diagonal pattern. You see people who draw trend lines all the time on charts. Everybody has a trend line on a chart. The story I like to tell people is you throw a chart book and a ruler and a pen in the cage with an ape, and sooner or later you're going to have a trend line that makes some sense. I'm not criticizing people that use trend lines. All I'm simply saying is that trend lines for me change the entire trading equation, as do all of diagonal patterns. My win rate at about 41-42% over time. Now somebody might say, well, you could flip a coin and be right half the time, but that doesn't take into account the trades I go into. I may be playing them with a very, very close and tight stop. Perhaps I'm risking $1 to make $5. And so that changes the equation, and it can't be looked at simply as a matter of flipping a coin in this case. But coming back to the Dow Jones Transportation Index, you see all sort of trend lines. If over the course of my trading history, I would have traded only diagonal patterns, my guess is that my win rate would be somewhere down in the high 20s or low 30s. And statistically, in terms of probability theory, there's just a massive difference in outcomes between a 30% win rate and a 42% win rate. And that is why I not only focus on horizontal patterns, but as we go through here, you see that I'm even more selective in terms of the horizontal patterns that I'm looking for. Here's another example of trend lines. This looks in soybean oil. And again, you can find all kinds of cases where trend lines, even trend lines that in this case have multiple points, while they sometimes change the direction of the trade, more often than not, trend lines morph out into something else. And so I avoid looking at trend lines. Here is an example of another diagonal pattern. This is a channel pattern that we can define in the Canadian dollar futures market. You can see the well-defined channel boundaries. Again, as a diagonal pattern, they can be some very valid ones. But as a general rule, they tend to morph. They tend to be much less reliable and therefore much more tricky to be able to make a market forecast or statement based on a diagonal chart pattern. Here we have the Euro Japanese yen cross, and now I'm looking again at another example of a diagonal pattern, and this is a symmetrical triangle. And you have this symmetrical triangle that broke out and failed, and broke out to the upside and failed, and broke out to the downside. Eventually, it became a symmetrical triangle that actually worked, but it had to morph. This is a perfect example when I talk about morphology. A chart tends to morph, they morph, they morph. Eventually, they'll work, but they morph. And diagonal patterns tend to morph more often than horizontal patterns. This is a wedge. Falling wedges and rising wedges are diagonal patterns. They can produce successful trades, and I'm not questioning that at all. What I'm simply making the case here is, as a trader, I'm looking for higher probability situations. I've found that making any sort of adamant statement about a market based on a diagonal chart construction is really skating on very thin ice. Here's an example that's currently taking place of the Dow Jones Utility Average, where you see that dating back all the way to 2001, and this is a semi-log chart. There are times I use semi-log chart. There are, for most trading applications using daily charts, I do not use semi-log, I use arithmetic charts, but this is a semi-log chart on the Dow Utilities, and you can see that it's currently in a rising wedge pattern. Here's another example of a current pattern, which is a diagonal pattern. This is in the French CAC, which is a futures contract traded on the major index in France. You can see a diagonal trend line. Again, this may break out and provide a very successful long side trade, but as a diagonal construction, it has much more tendency to morph and provide for a tricky trading condition. Here again is another symmetrical triangle. This one is in the US dollar Norwegian krona cross, where there's a symmetrical triangle that takes place. And for somebody to have seen this breakout, downside breakout in the US dollar Norway, and to proclaim a bearish case would have eventually proven to be quite wrong. And so my observation, my experience, and in some cases it's been experienced through the School of Hard Knocks, is that diagonal patterns are just destined to morph and to frustrate traders. And hey, trading's hard enough, so why invite trouble? And that's just generally how I view diagonal patterns, as a trader is just inviting difficulty into the trading scheme of things. I think there are probably two reasons why traders tend to like to at least identify diagonal patterns. I think one reason is that oftentimes traders, especially traders who write for an audience, who speak to an audience that follow them, they don't want to come out and say, I have nothing to say about markets. They need something to say about markets. And for a chartist, that means you need to find something, you need to point to something. Well, as I've explained and will further explain, most of the time markets defy understanding from a classical charting point of view. And so the need to always have an opinion on a market or be pointing out something about a market tends to lead somebody to lean on diagonal patterns to be able to point those out. I think the second reason, and a more dangerous reason, and sometimes very subtle, very cunning, is that traders want to be able to justify a bias or a position that they have. Maybe it's bullish or maybe it's bearish. And so a trader, and they don't do it out of deception, but they're trying to support a chart case to align itself with what their positions are in the market. And so they're looking for diagonal patterns in that way. I'd like to turn my attention at this point to those patterns which I consider to be my bread and butter patterns. And these are patterns that are horizontal, what I define as horizontal patterns. The first one I want to look at here, and there are three that I will focus on. They are the head and shoulders pattern, which is a head and shoulders bottom or head and shoulders top. There's the right angle triangle, which are known as either ascending triangles, where a triangle is shaped where it comes out of the flat surface, or a descending triangle, which is slanted down on the upside where markets tend to fall out of the bottom or the horizontal boundary, and then rectangles, which is a trading range that is bounded by two horizontal patterns. These to me are my bread and butter. And so I first want to look at the head and shoulders pattern. What you see here is an idealized diagram of the head and shoulders top. What is happening during this case is there is distribution. Generally speaking, one can assume if there is a sizable trend in a market, you have had some real deep pocket people with huge positions that have profited from it. As a general rule, sometimes there's massive moves that catch everybody by surprise. But by and large, you have very smart, deep-pocketed traders who usually are on the right side of major trends. Well, these trends will eventually change. And what happens is you can see through these patterns the behavior of large traders and how they are responding to rallies and dips and so forth. And the head and shoulders, what you see is a process where large traders are distributing their position and actually in some cases getting short. And so you have a rally to the left shoulder followed by a break. Now large traders will attempt to manipulate markets, spread rumors. I mean, in futures markets, of course, these are all completely legal things to do. And then the market rallies, makes a new high, traps the little trader and allows the large trader to dump their final positions. Markets break back to the neckline, rally to the right shoulder, and a reversal takes place. This is an idealized look at this. Now I want to show you an actual market, and you'll see the exact same pattern take place. And in this case, it is the cross rate between the Japanese yen and the US dollar, or the US dollar yen is what it is referred to, or dollar yen. Is you'll see that the market made a left shoulder, broke, made a head, which is a little more complicated. I mean, idealized diagrams are one thing, and you'll see on these charts sometimes it's a little more complicated than that. Made the right shoulder, and then we saw a pretty substantial downward trend. And here is a look at an idealized diagram of a head and shoulders bottom, which of course is just the reverse of a head and shoulders top. In this case, you have large traders who have been trading the market from a short side. You see the coverage on the left shoulder, the rally to the neckline, the head, the rally to the neckline, the right shoulder, followed by a trend reversal. This is a flat boundary line, and therefore I define this as a horizontal pattern. Again, my emphasis here is probability and reliability, and I have found that horizontal patterns are far more reliable than diagonal patterns. Here is a look at an actual head and shoulders bottom. This is soybean meal, where you can see the left shoulder, the head, the right shoulder, followed by a sizable rally. And in this case, the head and shoulders was, in the case of the head and the bottom, what we define as reversal patterns. There are also cases where we see the head and shoulders formation take place, not at tops, not at bottoms, but at midpoints along a major trend. These are called continuation head and shoulders. I don't have an idealized diagram of that, but I'll show you an actual chart of a continuation head and shoulders pattern. This particular chart shows a head and shoulders continuation that formed in gold from early 2008 through the third quarter of 2009. And of course, those people who were trading gold at the time know that when we completed this flat line top of the head and shoulders in gold at around $1,020, it led to a fairly quick trend to $1,900, a very substantial pattern. The second major category of horizontal pattern that is instrumental in my trading is what they call the right-angled triangle, or the ascending triangle or descending triangle. Again, where prices break out of a well-defined pattern through a horizontal boundary line. On this chart, it shows the idealized diagram of the two varieties of right-angled triangle. On the top, you see the descending triangle. What takes place here is that a market rallies and meets substantial supply. That supply brings markets back down. Each subsequent rally meets more and more aggressive selling pressure. And so you have selling pressure that is more aggressive in being willing to sell at a continually lower prices that meets support at a certain level. There's a point then where that support, that flat boundary line support, gives way and the market follows by falling away quickly. Just the opposite occurs in ascending triangle, where market meets demand, it meets overhead supply, pulls back, and during the course of the formation of an ascending triangle, buyers become more and more aggressive, whereas sellers are just kind of scattered around at a pretty much the same level. Eventually, the selling dries up, and the buyers take over and really gain control of the market, and trends go up. I will show you an example of a descending triangle that took place and completed itself in October of 2016 in gold. The market underwent a descending triangle that began in the summer of 2016, was finally completed on October 4th of 2016, and this resulted in a decline in the price of gold from around $1,300 down to a price of about $1,130. That's a substantial move that was produced by the breakout of a descending triangle. Here we see an ascending triangle. This is probably going to go down in history as one of the classic textbook examples of the ascending triangle pattern. And this particular chart is the US dollar Chinese yuan, where the market underwent a 20-month ascending triangle period, broke out, and you can see what has happened to since. I think there is perhaps a very strong probability that the dollar yuan will never, at least in my lifetime, return back to the levels it was at during the construction of this ascending triangle. The third major category that is in my list of chart patterns I want to focus my trading on is the rectangle. And the rectangle is a chart formation that takes place within the boundary of two horizontal lines, one on the upper side, one on the down side. And a rectangle can be either a reversal pattern where prices go up, form a rectangle, trade sideways within the boundary of two parallel lines or relative parallel lines, followed by a bear move. It also can take place as a continuation pattern where during the course of an up move or a down move, a rectangle forms and then is followed by a continuation of the trend that preceded the formation of the rectangle. In this chart, you can see kind of an idealized diagram of the rectangle pattern, where you see in this case a rectangle which is a continuation rectangle on the top where prices go up, meet supply at a certain level. When prices break, they meet demand at a certain level. That continues over the course of time, followed then by the resolve and the wiping up of all overhead supply and the continuation of the bull trend that preceded it. In the lower case, you see a rectangle which was a reversal rectangle. Both are very valid patterns. Again, this represents the type of patterns, the horizontal patterns that I have found far less subject to morphine with a much higher level of reliability. And sometimes that results in much less frustration. And the frustration of trading certain patterns can never be ruled out as an important factor in the equation. Here is an example of a rectangle that occurred in the gas market starting in 2011, April in 2011, finally completing itself in September of 2014, where the price of gas traded within a rectangle boundaries, a very broad rectangular boundaries, eventually was resolved and that led to the great bear market in the energy markets that began in about June of 2014 and then continued down into a bottom that finally took place in February of 2016. And this bear market, of course, was really one for the ages. In the case of gas, this bear market originated from a rectangular pattern. Here's another example of a rectangle. This one is a continuation rectangle that took place in the cross rate between the US dollar and the Turkish lira, where the dollar was gaining on the lira for a considerable period of time. The market began to form and drift sideways within the boundaries of a rectangular pattern, finally broke out in October of 2016, and then we saw a substantial rally in the US dollar against the Turkish lira. Now, it just so happened that that rally took place against the backdrop of an apparent overthrow in Turkey. There was a lot of political instability in Turkey. Now, some people might have traded this market based on that instability. To me, the things that are taking place out there in what might be called the global macro or fundamental perspective are incidental. I basically don't pay attention to the news. I try to keep myself cloistered and away from the types of things that most people are on the edge of their chair waiting for CNBC to record. And so I try to ignore the news and pay attention to the charts. Here's another example of a continuation rectangle. This one was in the cross rate between the British pound and the US dollar. That is a cross rate that is nicknamed the cable. But you see this sharp decline here that took place in June of 2016. That was the Brexit decline. That was the decline that took place the day after the Brexit vote, where England kind of withdrew from the European Union. Following that decline, the market drifted sideways in just a perfect rectangular pattern. Broke out in October 3rd. That's the kind of move I'm looking for. I'm not looking for, moves representing 50 or 60% of the value of the underlying item that you're trading. I'm looking for moves that are in the magnitude of 5 to 20% or so of the underlying value. And I've just found that these horizontal patterns are excellent at identifying those types of opportunities. There is one final form of chart construction that I have found to be quite reliable, far less subject to morphing than diagonal patterns. These are very brief patterns. They are what I call typically half-mast patterns. They're flags and they're pennants, and they occur during the course of very, very strong trends. And I think one of the values of charts is that you can look at a chart and you can see if a market is in a sustained trend or if a market's kind of going up and going down but going nowhere. It's really easy to see in a chart a market that's in a very strong sustained trend. When we get a market that's in a strong sustained trend, it can form flags and pennants, which, while brief, can be quite reliable and quite profitable when properly traded. I'll show you a couple of examples of this. This first one is in the Dow Jones Industrial Average, where, of course, we see the Trump blast-off that took place last October and the bull market that we've had in the Japanese yen ever since. And you'll see this period that began in about mid-December and went through early February that took place that wasn't a rectangle, it wasn't an ascending triangle, descending triangle, or head and shoulders, but it was just kind of a tight area congestion that took place during the ongoing development of a trend. In this particular case, I define this as a pennant. Now, you might look at this and say, well, the breakout was through a diagonal line, so why would I not call it a diagonal pattern? Well, in this case, the diagonal pattern was in the direction of the trend, and so the breakout was through a diagonal pattern which supported the trend. There's a difference between breaking out of a down trend line where the market's breaking up through a slanted line going against it, and a market that breaks out through a line that's diagonal going in its direction. But I have found these brief pauses, in this case I would define this as a pennant, to be very successful as trading vehicles. The second case that I want to show you of brief patterns within the perspective of the chart that we're looking at is the weekly chart of the dollar yuan, where we see during the course of a substantial move two examples of a market that just kind of drifted. In the first case, you can see kind of a down channel, which on the surface is a diagonal pattern, but the fact that it took place after a straight line move makes me ready to be willing to trade it, even though it is a diagonal pattern, because it came within the construct of a sustained, almost dramatic move. In those cases, those are cases where we get a flag. Flags are more dependable in a typical diagonal pattern. And then the second pattern we see in the dollar yuan took place starting in July, going through October of 2016, where the market formed a pennant. It went sideways. It was a brief pattern in terms of number of bars, resolved to the upside. And so that's kind of a separate case. It's not purely a horizontal pattern, but for me it offers sometimes excellent trading opportunities when we find a market that is in a sustained trend and then goes just through a low period that forms a flag pattern or forms a pennant pattern. I have found those patterns to be quite reliable from a trader's standpoint. Let me summarize this video that we've had on classical charting and technical trading, and just kind of summarize the key points that where we've gone. Here is what I would define as the key points. You know, charts show where markets have been, and they show the path of least resistance, and that's it. You know, charts cannot be used to comprehensively diagnose a market, cannot be used to really do accurate price forecasting. They're too unreliable for that. Even horizontal patterns are. Charts are useful to gain a perspective of where a market has been, where it is right now, and where the path of least resistance might be. Charts are not reliable to do comprehensive market forecasting, and always have an opinion on any given market at any given time. That's not really the function of charts. That's not the purpose of charts. Charts don't forecast prices. I think that chartists must acknowledge the fact that most chart patterns fail. Now, of course, I've talked to chartists who say they're never wrong and none of their chart patterns ever do fail. But I'll tell you, I've made my living from charts. You'll find no bigger proponent for the craft of charting than I am. In my experience is that most chart patterns do fail. Another point is that diagonal chart patterns or diagonal chart construction, which is trend lines, symmetrical triangles, channels, wedges, and the like, are really so unreliable that in my view, they should not be used as a key component of chart-based market speculation. That horizontal patterns have the highest degree of reliability, that they have the tendency to morph less than diagonal patterns. And then one final point I didn't touch on, but I think must be pointed on, is that the duration of a horizontal pattern I have found to be extremely important. Once horizontal patterns get to be multiple years, and there are those cases that becomes multiple years, they may be good for an overview of a market, but they really become useless for the purpose of trading. The trading really needs to be geared down into daily charts. I have found that the most reliable are horizontal patterns that are between 10 and 26 weeks in duration. That is really the sweet spot. That's in my wheelhouse. Those are the patterns that I'm looking for that are very clear. And just one final side note, what do I do with a pattern that it looks like it might be, but I'm not sure it is? I ignore them. I want to see patterns that are just undeniably clear. And so that's kind of a summary of where we've been in this chart. In the next video, I'm going to really address myself to the role of human emotions and character traits in the whole equation of trading. Charting is an interesting thing. If you get in a room, 10 different chartists and show them a chart, you're going to get about 15 different opinions. As a trader, I realized that my daily challenge, my challenge each and every day is just to recognize ways that my emotions, my sense of anxiety and fear and greed and all of those other things attempt to sabotage what I'm going to be doing.